So we're in the 369 studio lab on our Never Broke Again podcast. Got Andrew Saltman. He brought us Gino. Is it Barbaro? I want to make sure I say that correctly.
Barbaro, yes.
Barbaro. Gino Barbaro. And Gino is going to share the secrets on how he's never going to go broke again. So thanks for coming on, Gino.
Guys, thanks for having me. The topic is never go broke again. And, Andrew made a comment of, spend less than you make. If it was that simple, a lot of people wouldn't be going broke. I think the problem with money is it's such an emotional topic. And I think the first thing people need to understand is money is just a tool. I mean, if you really understand that, it is only a tool. You're getting money, you're buying something of value, and you're exchanging that money for something of value. If people can understand that concept, it wouldn't be too difficult. But then you start tying money to things that are emotional. And once our emotions go up, I just finished reading a book called Reasoning, right? Let's get reasoning back. And let me start off the podcast with this quote, because I thought the quote in the book was great. The quality of your mind leads to the quality of your decisions, which leads to the quality of your life. Now, if you're making decisions based just solely on your emotions, do you think your decisions are going to be really good or not so good? I think most people out there, when they have money, they're making decisions based just on emotions and not logic. We've lost that logic. We've lost that capacity to reason, right? We've lost the ability to, to actually go out there and argue and to talk about topics. And if you can't do that from a logical perspective and only taking your emotions into it, then what's going to happen? You're going to go broke because you're going to make emotional decisions not based on logic. Should I buy a house for $1 million? Yeah, I really want it. I love it. My wife loves it. Great school system. Can we afford it? No. You're going to go broke. That's what's going to end up happening, because that $1 million house, all of a sudden, when you make more money, the ditto effect. You start earning more money, you start wanting to spend more money. And that $1 million house all of a sudden doesn't seem like enough, and you want to spend $1.5 million because you just got a raise. Instead of going out and buying an asset with the money, you go out and you buy another liability. So I think really when you talk going broke, it really comes down to your emotions and how you start making decisions in life. And we can all start today by making better quality decisions if we can start thinking about how we're making those decisions. Is it just based on emotion, or are we using logic and intertwining the both? Because we do need an emotion. We do need to be excited about what we're doing. But it can't be just about excitement. It needs to be some logic behind that excitement. Does that make sense, guys?
Yeah,
totally.
I'll play devil's advocate for a sec, because you could say debt motivation, right? Mm-hmm. You could say, "Hey, go get that house."
Mm-hmm. Is that what Brad Lee says?
When I don't know about that, but I know Rick Ruby says that he loves debt motivation. Go into debt. And then, to motivate yourself, because a lot of people aren't motivated to do anything or make money. So go into debt. How you have to.
Does that make sense to you? I mean, to me, that makes absolutely no sense. I'm going to get motivated in another way. I'm going to get motivated by providing for my family, or I'm going to get motivated to leave impact, or I'm going to find another motivation to motivate myself. I don't want to put myself behind the 8 ball, especially if I'm buying a liability, a doodad, as the rich dad would say. Let me go into debt by buying maybe a 3-family, or buying a business where I can actually generate money to go and create wealth for myself. Let's talk about personal debt and business debt. Those are 2 very different topics that we're discussing here right now. Most people focus on personal debt. Let's put debt on credit cards. Let's put debt on other things. I was doing a podcast with a guy named Bill Jennings, and we're talking about credit. Do you know that if you have $10,000 of credit card debt and you pay the minimum monthly balance, do you know how long it's going to take you to pay that credit off? 30
more than 10 years.
Freaking years. 30 years. So go motivate your ass by putting debt on, and then you can't pay that debt back, and you're paying it for the rest of your life. So let's understand, if we're going to get ourselves into debt, let's get ourselves into responsible debt, because leverage is an amazing tool. You're using other people's money, but it works both ways. You can either lever up and do fantastic, or you can lever down and you can go broke real quick. So understanding the difference between personal debt and business debt. We want to lever our business debt, we want to lever our business to pay for our personal. And I think people get that confused when Dave Ramsey says, "Oh, no debt." Most people out there shouldn't go out and leverage stuff because they don't understand how to invest their money. They don't understand the principles. Money is just a game. I had Andrew Cordell on our podcast a few weeks ago. Money's a game like anything else. If you're out there playing football and you don't know the rules of football and you're playing with a hockey stick, you're not going to win the game. You're not even playing the right game. So understand what those rules of money. That's why people go broke, because money is just a game. You can either have a poor mindset, you can have a middle-class mindset, a rich mindset, or the wealthy mindset. For instance, the middle class mindset, where I was for a long time, we're taught to save for an investment. We're taught to save for college, for an event. My kids are going to school. I'm getting married. My kids, I'm going to retire. That's the event we're saving for. That's the middle class. You put money in a 401k and a 529. Who's getting wealthy? The financial people who are controlling those assets. The wealthy person goes out and saves and buys an asset and has that asset pay for the event. That's the rule of money, which most people don't do. Because in 2013, I bought my first multifamily asset, 25 units, a $650,000 asset.
That was your first purchase?
That was
25 units?
With Jake, yes. Well, I had a couple other smaller deals, but our first really sizable multifamily property that we did together back in 2013, 25 unit, little crack den. It was a small property back then. For us, it was huge, but for the average person saying, well, and with the long-termism, we've owned the property since 2013. Rents were $350 when we took over. Now, rents are $995. We average every month between $8,000 and $10,000 a month in cash flow. Now, there's 3 of us in the deal. So I get about $3,000 a month on that property per month. Every single month for the last 9 years. You guys do the math. That one property has paid for my first child to go to college. She graduated. My second child is up to bat. He's a sophomore. Guess who's paying for that deal? I have 6 children, guys. All 6 of them are going to go to college. They're all going to get paid by that one asset. I'm still going to own that asset. My residents are paying down the mortgage. So they're paying for my bills. Whatever's left over, I'm using. I have depreciation on that asset. I have appreciation on that asset. When I want to retire, that asset's probably worth $3.5 to $4 million in the next 10 to 15 years. I will sell that asset, and all of a sudden, I've got my retirement. And even better than that, I can sell that asset on a seller finance note, have the seller pay me monthly things so I don't have a cash flow problem when I retire. That is the rule of money that I didn't understand 10 and 15 years ago. Save money to buy assets, and those assets will pay for those events. They'll appreciate over time, and you'll be able to do whatever you want to in the future. So just one simple example. Let's learn what kind of game we're playing. If we learn the rules, we'll be able to be more successful at it.
Let me throw in a wrinkle and see what your thoughts are on it. So what are your thoughts on buying stock, putting the money in the stock market, and then borrowing on margin against that stock? Do you do that?
I don't invest in the stock market. I think it's the biggest Ponzi scheme on the planet. That's just my personal opinion, because the problem is I have ownership, but I don't have control. I mean, Elon Musk can throw out a tweet and I'm down 30%. The war in Ukraine, I don't have control on that. So for me to have that type of margin, I don't have the skill set to be able to do that. If you're going to play the rules of money, you better be a really damn good stock investor. You better be doing it every single day, and you better have control, because that can go real bad real quick. You can be down 3,000 points in 3 days, and all of a sudden you get margin calls, and it's out of your control. For me to buy an asset, I love stocks in the fact that if you're going to do stocks, learn how to do puts and calls. Learn how to control the market where you're selling puts and calls, and when you're buying stocks that actually give you dividend, give you a yield. Like, that's what I love about multifamily. Multifamily produces cash flow, which is AKA a yield. And it also throws off amazing tax benefits. That's why I love the multifamily space. That's why I love real estate in general. You can create a business around it. You know, Jake and Gino, we create multifamily entrepreneurs. You become an entrepreneur when you're buying these assets. With the stocks, it's one and done, basically. It's a different asset class. It's something where you can still put money into it. I don't. I personally like putting any additional capital that I have in whole life insurance, use that as a savings vehicle, pull the money out, borrow from my cash value, and be able to buy other assets. We call it the dual asset strategy. But for those of you guys out there that are thinking about doing stocks, be very careful. I mean, I want to know how Starbucks and Panera and all these other companies are creating revenue and creating profits when they can't even deliver the goods and services. Starbucks are freaking closed at 2:00. They don't have. How are they making profits in this economy right now? I just asking that question. To me, that's a Ponzi scheme. You're going for the future. You have companies that are trading at these multiples that make absolutely no sense, and they're hoping and wishing and praying. And if something happens, what happens? So for me, you better know what you're doing in the stock market, because you can go down real quick, bro.
I love it.
So what were you doing before multifamily? What was going on before multifamily, Gino?
I owned a restaurant for years and years and years. I had one restaurant with my family. We bought it in 1994. So I've been making payroll for a lot of years, boys. And, you know, the first 10 or 15 years was great. Less competition. The internet wasn't around, no Grubhub, no Uber, none of that crap. You were making money, right? And I was in New York. So the tax situation was much different. The economy was much different. In 2007, Pops passed away. And I was like, I don't want to do this anymore. I grew up with him in the kitchen. I loved being in the kitchen. I loved doing that. It was a way for me to provide for my family. My family worked with me. I truly enjoyed it. But once the internet started taking over, people's eating habits started taking over. The Great Recession came around. I'm working harder. I'm making less. How many out there feel like that? I felt like that. I said I need to find another vehicle to be able to invest my money sort of passively and be able to do the restaurant at the same time as I'm doing the real estate. I didn't want to fix and flip homes. I saw that as transactional. I started reading the book Secrets of the Millionaire Mind by T. Harv Eker, and I'm like, responsibility, your fruits and your roots. I've got to learn another skill set. I'm getting paid by the value that I'm creating. And I wasn't creating a lot of value other than that one restaurant. That's the reality. And I started building a business around that. I started writing a cookbook. I started doing physical products. I really started enjoying it. But at that point, I met Jake. Jake moves down to Knoxville, Tennessee. And I'm like, Jake, when you get down there, let's start looking at these assets. Let's start buying multifamily, because he's a pharmaceutical rep taking orders out of my restaurant to go to doctor's offices to sell his pharma drugs, his legal drugs. That's what he was doing at the time. And I'm like, when you get down there, let's start looking at assets. We can do it part-time while I have the restaurant. And maybe there's a runway in the next 3, 4, 5 years. If we acquire enough multifamily that I can leave the restaurant, you can leave your job and we can do it full-time together.
So you started, when did you start that? When did that happen?
2009. Yeah, 2009, I met Jake.
Okay.
I became good friends with him at the restaurant. So I already knew his values. I knew his hard work ethic. 2011, he comes to me and we're sitting down in the restaurant and he's like, dude, I'm leaving. We pull out the laptop and I start looking at LoopNet. I'm like, holy crap, these deals actually cash flow. They make a lot of sense. Although remember, everybody, back in 2011, 2012, 2013, GDP was abysmal. I mean, the economic, it was just horrible. H1N1 was going around at that time too. There's just the sentiment was terrible. Rents were in the toilet. There was no money out there. So syndication wasn't around. So the valuations were where they were because that's where the economy was. And, 2011, he moves down to Knoxville. And from there, it takes us around 18 months to find our first deal. 18 months, everybody, because we didn't know what we were doing. We had no idea how to find these deals. Jake's fiance at the time moves down. So he stops for a few months. They buy a house, and then we start that process over again. But after that 18 months, we find the first deal. 3 months after that first deal, we found our second deal, which was a 36 unit. And then 6 months after that, we found our third deal, which was 136 units. So, I mean, it's the momentum in life. Once you put in the time and you put in the effort, you put that education, then education times action will ultimately equal your results. That's what happened with us.
So multifamily is a hot topic, right?
It is.
So, obviously, like you're saying 136 units. That's like, that hurts people's brains, right? Unless you're like a master at this, obviously. You've got how many units? How many units do you have now?
We're at about 1,500.
1,500. So you're a master at multi. So
I wouldn't call myself a master.
What's that?
I wouldn't call myself a master. I'm
a master class, right? So how does someone starting out, like you're saying, 136 units, how does somebody just jump right into 136 units? That hurts my mind. Like, is that even possible?
So that's the secret to never going broke again. You just don't jump. You don't jump into something that you don't know. The first thing you really truly have to do is you have to sit down with yourself and have an honest conversation with yourself. I had an honest conversation with myself. I said, I want to get into multifamily because I had done mobile home parks. I had failed in that deal. I had done a strip mall up in New York. I failed with that. I said, why do I want to get into multifamily? And this was years ago. I wanted to have a stable stream of income. I wanted to have a little business. And I knew conceptually, everyone's telling you to go big or go home, that I couldn't take down 136 units on my first deal. And that's okay. I always say think big. But Andrew, start small.
But still 25 and 35 units are a lot.
Yes.
Of units, right?
So I had started with a fourplex with myself and my brother back in 2002, years and years ago. So I sort of had the flavor. Start with the fourplex. If you're a young person out there listening, house hack. Buy a duplex, live in one unit, rent out the other, get the feel for it. But you need to really seriously take your education, because what I did is my wife at the time said, if you want to do this, I have full faith in you. I had 5 kids at the time when I started with Jake, and I'm like, you know what? I'm full into this thing. And I knew that if I was going to fail, it wasn't from a lack of effort. I spent hours educating myself. I even went to coaching school, life coaching school, to understand what my why was, to understand why I'm doing this. Because that's the reason why, the reason, if you can't figure out what your why is, all of a sudden you're going to start underwriting deals. And like you said, Andrew, it is very difficult now. There's a lot of deals that aren't making sense, but it's called the market cycle. We will come back. We have short memories of 3 and 4 years ago. I want to ask all the listeners out there, back in 2018, how many of you thought multifamily was at a high? Everyone's going to say yes. 2019, 2020, we've been at the high of the market for the last 4 or 5 years. When's it going to end? It's eventually going to end. That's why you need to get educated about market cycles. And you can make money in the stock market when it goes up and when it goes down. You just need to know what to buy, what to sell short. And it's the same thing with real estate. You need to know what kind of assets you are going to buy now for the long term. As in the last 3 and 4 years, people have been flipping out of assets and going into scaling up and syndicating. That's going to stop right now, because as you get higher in the market, these valuations don't make sense for people to hold these assets for such a short term and be able to flip them. But back to your answer, your question about how do you get into it? You start small, or you partner up with other people. Or you start.
How did the structure of the deal for the 136 units look like?
So Jake and I don't want to say that we're unique, but we're a little different. We like to buy our own assets. Those 1,500 units, we only have one deal that's syndicated. The remainder of them have just me, Jake, and a partner named Mike. So we've been able to refinance out over $20 million and buy the next deal. Instead of going out and buying the Lambos and buying the 3 houses, we reinvested our money into buying more assets. So if you're going to lever up and use that leverage wisely to buy another asset. And it's paid off for us because the market cycles continue to rise. And with long-termism, we've been able to hold those assets for the long term. When you speak to such intelligent people that have been doing this for years, people have been doing this for 40 and 50 years, their 2 regrets usually are they didn't buy enough and they sold too soon. So Jake and I said to ourselves, let's hold these assets for as long as possible. And ironically, we sold 2 of our deals, two 8 units. We bought them back in 2016 for $37,500 per unit, this 8 unit. We sold it for $102,000 per unit. Hey, we made $60 a door on an 8 unit. That's 500 G's. Yeah, well, that asset right now, a year and a half after we sold it, is worth $140 a door. So were we great? Were we smart? I don't know. At the time, we took that equity and we placed it into another deal, so that's okay for us. But when you're thinking about it, real estate really is about long-termism and really creating that ultimate wealth. But for us to go from that 36 unit to the 136 unit, we needed the balance sheet. We didn't have the balance sheet. We found that partner, Mike. Remember, when people talk about, how do you find these deals? It comes down to people say you're lucky. I was lucky because I worked my butt off, and I was lucky because I was always out there talking about what I was doing, and I attracted my partner, Mike, through the restaurant. He was a customer. He was a hedge fund trader. So I'm sitting in the restaurant one day up in the front. I got my shirt, my pizza shirt. It's got sauce stains on it. And I'm sitting there, and he's picking up food to go, and he sits down next to me, and he starts talking about China and about oil and about gold because he's a commodities trader. And I think I probably confused him because I knew what he was talking about. And I was actually having an intelligent conversation with him. And I said, oh, by the way, I'm investing in real estate. You're buying homes up here in Connecticut for $2.5 to $3 million and renting them out for $10,000 a month. Those numbers don't make sense. We're buying an asset here for $800,000 that has the same rent roll that you do for $2.5 to $3 million. I piqued his interest. I was able to talk intelligently about the asset. Next conversation we're having, hey, want to partner up with us? So he partnered up with us on our second deal. On that third deal, Mike was the balance sheet, and he had a significant net worth, so he was able to put about 40% of the equity into it. Jake and I came up with the remainder. Grandma, grandpa, we even had the seller, we even had the broker hold the seller finance note for part of his commission. We were strapping, and we were able to have Mike loan us $500,000 for the down payment because we knew this deal, we'd be able to refi this deal and actually refi it out. So we're able to get more equity because Mike was able to loan us money to the corporation. We paid him a 5% interest rate. 18 months later, we were able to refi him out. But being creative and knowing that we had an amazing asset, an amazing opportunity, and being able to convey that to somebody who was smarter, who was in the business world, but was just in the wrong asset class, all those things came together in that third deal. And ever since then, we've been, partnered up.
Was it difficult to leave the restaurant? Was it a difficult decision?
For me, I had just gotten burned out and I lost my way with the restaurant. I really wish I had done core values with the restaurant. I really wish that I had dove into and understood how many people's lives I had really affected by the restaurant. Because, it's something when you start doing something for years and you just take it for granted. But if you really step back and take a look at the service I was providing to that community, people coming home from work, people having bar mitzvahs, people having communions, confirmations, wedding parties. And I started looking at it as a commodity, as I'm just going in and doing work. And when I left, I hated working on the weekends. I hated working during the holidays. There's certain aspects that I really didn't like about it. I just had learned to work really hard. So that's just transpired into what I'm doing now. But for me, I didn't understand. And I think everyone out there who's got a business, step back and take a look at who you're serving. I mean, I didn't do that. And that maybe would have made it more difficult for me to leave. But I left my identity. I was the pizza guy until I took on another identity of being a multifamily investor, of creating the Jake and Gino community, taking that identity. It was difficult from that perspective. And, from being known in the community and having an effect on that. And really, ultimately, what I ended up doing was I left the restaurant. A year later, I left New York and I moved to Florida. So I had a double whammy. I just needed to get out of New York. I needed that cut. I needed to have a boundary between the restaurant, which was my former life, and this new life that I was starting to create. So for those of you out there that are doing it, you don't need to do it all at once. In October of 2015, I decided, finally, let me stop working at the restaurant during the week. I'll work real estate full time. And then on Saturday and Sunday, I'll work the restaurant. I did that for 6 months. My wife wanted to kill me. In March of 2016, I said, I can't do both. And it's just saying, you don't have to listen to all these gurus telling you out there, burn the boats. You can be fully committed and do your full-time job and have the side hustle. I did that until I couldn't do it anymore, until I was financially capable. Maybe the quality of your decisions. I had around as much money as I needed to leave the restaurant to do real estate full-time. And that's what I ended up doing. And it was difficult because the name is Gino's Trattoria. So it was named after me, my grandfather, all those memories with my dad. I loved working that, but it was a hard job. And I said, ultimately, there's no future for my family. There's no future for me as far as creating wealth. It was a daily grind. It was transactional. Every week you work, at the end of the week, you get some money. If all of a sudden the economy slows down, people ain't coming in, you're not eating. If there's a week that snows, you're not getting paid. And that gets to be a grind after years and years and years, and not being able to spend time with your family on Christmas Eve and working on Easter and working all those holidays. So it was bittersweet. It was great to leave, but at the same time, it was challenging.
What was your favorite memory of the shop, of the restaurant? Do you have anything that sticks out in your mind? When I was what do you think when you think of your restaurant? Is there a moment that comes into your brain that just makes you smile every time you think about it?
Yeah, this may sound crazy, but just seeing my mom's car pull into the parking lot and knowing that she was there. It's a family place. That's why I created Jake and Gino. It's all about the family. I want a small team, and I can rely on her. And I loved working with her. I loved working with my dad. I loved working with my brother. The employees, to me, also felt like a family, and that's what I loved about it. Going in there and just having people come in and just know that they were getting a quality product. We had a great pizza pie, believe it or not, which I got to stay away from the carbs now, but the food was fantastic, and I love the atmosphere. I love what we created as far as that was. I just couldn't scale that. It was hard to scale it. And as an entrepreneur, we're trying to scale and bring value to as many people as possible. That's how we make money. The more people you can serve, as Zig Ziglar says, if you get enough people getting the product that you have, you'll get whatever you want. I don't know. He says it so eloquently. I don't remember his saying.
If you help enough people get what they want, in return, you'll get what you want.
Exactly. Thank you. Something to that effect. And that's the only thing that I really regret about the restaurant. I couldn't figure out a way to scale it. I had started down that path, but I didn't. But seeing my mom's car pull in was yeah, okay, Mom's here.
Andrew, would you agree? It sounds like Gino working in the restaurant business has given him an unfair advantage in the multifamily business.
I don't know. Why would you say that?
Well, it's a service industry, and I mean, he's out there serving people and creating win-win situations.
There's a lot to that. That is a great analogy. And I would also say the other thing that most people don't understand is multifamily or any business is truly a hard endeavor. The whole thing that everyone talks about today, work smart. We need to work smart. Don't get me wrong. I mean, you guys are doing this podcast. I don't expect you guys to be editing the podcast and doing those low-level tasks, but you need to work hard. And most people don't understand that fact. It's working hard, doing the things that you don't like to do, where ultimately you can do the things that you do like to do. People want to skip over those don't like to go right to the like. And in the beginning in our portfolio, Jake and I, we did everything. We did the bookkeeping. We had our own property management company. We were creating the systems. Now, as you start scaling, you have to understand you have to leave that former life, which I wasn't able to do with the restaurant business. I was washing dishes. I was stuck in the kitchen. I wasn't able to leave that former life to be able to scale the business. So all of those skills of hard work and understanding the getting it off the ground, you need to have that. And then ultimately, multifamily, like you said, you're walking into an office, it's all customer service. You're talking to a property manager, you're talking to maintenance tech, being able to convey that and being able to understand and be empathetic with the employees that it's a thankless job sometimes. Property management's great. All of a sudden, the hot water heater goes out, it's all hell, right? Same thing with the maintenance tech. Everything goes really well, then all of a sudden it goes out. And you have to understand as a business owner, I've been in the kitchen. I've been washing dishes. I've been there when it's 110 degrees. Being a maintenance tech and going out there, being a plumber, being an electrician, those are hard jobs. And I think understanding that coming from that realm made me, I guess, more successful in the multifamily space.
What do you feel like it's important in a business to work all those lower level jobs? And as you scale, it's like, all right, now I'm not going to do maintenance. I'm going to hire someone. Hey, I know bookkeeping, but I'm not an accountant. I'm not doing this shit anymore. Like, but if you work with and sit down with your accountant, you're like, hey man, you're not doing this, this, and this. And so that way you can identify when someone's maybe looking to cut corners. How has that benefited you?
That's a personal choice, I think, for everybody to do it. I mean, Jake is the worst bookkeeper ever. I mean, like we gave it up after like our third. I mean, that was the first thing we gave up. I'm terrible at editing, so I wouldn't give it up. I don't think you have to start with every task, but I think the main tasks to understand it, because if you're trying to create systems within your business, how do you create a system for customer service? If you've never greeted a person coming in, you need to have somebody that has that skill set to be able to create that system. And it's the same thing with bookkeeping. You need to be able to understand, a statement of cash flows, an income statement, and a balance sheet. I mean, at the very minimum. And it's the same thing with underwriting. If you're underwriting a multifamily property, you need to understand how to underwrite that deal, because then when you have team members doing it, you need to be able to look at that spreadsheet and go, okay, cash on cash is here. Here's your debt coverage ratio. Your equity multiplier is this. Your IRR is this. You need to understand those things. So if you don't do them yourself, at least learn how to do them. So when you're delegating those tasks or you're reviewing those tasks, you understand what it entails.
So Andrew has Andrew, you got your box of questions?
I do.
Can we pull out a random? Can we pull out a random question?
Yeah, I will. But I also read, I think, both your books. Do you have 2 books or 3?
We've got several. We've got the Honeybee.
Yeah,
we've got
that one and Bill Barrow.
Yeah,
really good.
We've got Creative Cash. We've got a couple of books that came out with our coaches, believe it or not. So this Creative Cash book is good. What I'll do is if you guys email me, send me an email, Gino@jakegino.com. I'll send you a PDF copy, because the book right here is about seller financing and about mass lease options, about creative financing techniques. And I think as this market cycle starts to lengthen, a lot of these deals aren't going to be financeable. I think that's when debt starts pulling back. That's the circulatory engine. You saw what happened in 2008. All of a sudden, these deals aren't financeable. That's what may happen in the future. I mean, I don't think banks are going to pull back. I just think a lot of these deals aren't going to make sense. I think, these debts are going to want higher, lower loan to values, so they're not going to make sense. A lot of these mom and pops are not running these properties properly, so your income, your rent's going to be so low that you can't go to a bank and get financing. Right now, 80% of all deals are done by bridge debt. So that tells you there's a lot of deals out there that are just not stabilized. So I think creative financing.
Done by who? They're done by who?
By bridge loans, by bridge financing.
Oh, okay. Yeah.
So think about it. You're buying a stabilized asset that's actually running properly, but it's so overvalued, or they want so much money in excess of what it's worth today that you can't go out and get stabilized financing. You need to get a bridge lender. So there's where the risk has been for the last 6 months. If interest rates go up, that's where the risk is, because all of a sudden 2 years from now you're refining into a higher interest rate that you weren't assuming, and that's where I think a lot of the risk is lying in the market right now.
Where are you guys? Are you guys buying right now? Are you always buyers, or
we are always buyers? Yes, we are within 3 hours of Knoxville, Tennessee, because we're what we call a vertically integrated company. We run our own property management. We buy, we sell, we take care of every aspect of the company. So what we want it to be within 3 hours of Knoxville. And as far as buying in this part of the market cycle, these small deals may make sense. We bought a 25 unit in December. We closed on a 21 unit last week. We've got a 40 unit, we've got a 18 unit, and a 12 unit. All three of those are under contract right now as we speak. These smaller deals make a lot more sense because the mom and pop investors, they think they're too big. And these private equity companies, these larger institutions, they don't want to waste their time on these smaller units. And for us, we have larger assets. We're able to combine those larger assets with these smaller properties, and we're able to manage them efficiently. And the other thing we're buying land, because I think in the future we want to be able to build some of these assets. That build rent model is phenomenal. So we bought a couple of sizable properties in Knoxville to be able to start building the next year.
You gotta buy the land near the schools, right? The colleges.
Oh no! I mean, what we're doing is
high student rents.
No, what we're doing, we don't want student. What we're doing is we're buying in areas that median incomes are 70 to 80 to 100,000. We bought a piece of property that's 70 acres. We actually want to build duplexes. So good school district is important, but we're buying it in areas of town that we know that's where people are migrating to as far as housing, and we want to build a duplexes. We want to build 2-bed, 1.5 bath townhomes to build to rent. We want to own these things forever.
There is a methodology to that.
Mm-hmm.
It's look at you may know it. Look at a population growing. What is it? 10% or 15% year over year,
mm-hmm.
and then buy 8 miles out. Have you heard of this strategy?
No, I haven't.
Okay, I can't remember where I read that, but it was like, find a population growing 15%, and then buy 8 miles from the city center, the
8
land.
miles. Okay.
I can't remember the numbers. I was hoping you just remember.
No.
Is there like a formula, Gino, that you use to identify whether a property is a buying opportunity or not?
Well, for us, trying to get number of units on a property, we're just really comfortable with what we bought. We bought a piece of property for $1.2 million, 70 acres. And I know right now it's deeded for, I think, 250 homes, single family homes. So, the price per home, price per lot is one of those metrics that you can use. But we know that we're going to be able to zone in more housing there. So for us, I think for everyone, it's a little different. Like I said, we're building duplexes. A lot of these multifamily operators, they want to build garden style apartments. We want to get away from that. We want to build the single and the doubles. That's what we're looking to do. But like I said,
you're getting into single family?
Yeah, I think I'd love to build a single families as well. 3-bed, 2.5 bath homes. I mean, if you can build them for about $200 to $220 a unit, and you're able to get between $1,800 and $2,000 a month in rent on a brand new asset, that's a freaking home run, because that asset's going to last you for the next 20 years. Then the first 5 or 6 years, it's easy to maintain, easy to manage, but the life cycle is a lot longer. It's going to take between 24 and 36 months to complete a project like that. Whereas if you're buying a multifamily today, you're buying an asset that may be a little bit older, but you're cash flowing from day one. So having the ability to do both of those strategies really is going to pay off for us long term. So
when you're buying now, are you still taking out debt on all your purchases?
Absolutely. Yeah, absolutely. Okay. A lot of these things are loan to cost. You're getting what loan to cost is you're getting your proceeds of any of the rehabs in the loan itself. Because like I said, this 25 unit that we bought it for an average blend of $70,000 per unit. The rents were $600. So that deal does not make sense at that price point. We just started rehabbing and we finished 3 rehabs. The rents are $1,200. So $10,000 per door. If you do the math, we're going to be into it between $80,000 per unit. But the rents now are $1,200. That deal is going to crush. Unfortunately, it's only 25 units, but it's okay. But you're seeing what's happening. We had to get the loan to cost because that debt doesn't work if you're getting regular stabilized debt, because there's not enough your debt coverage ratio is too low. So for us to do that, we know we're buying on our pro forma, what we think we can perform in the next 18 months. The key is, everybody, don't buy on the broker's pro forma, buy on your pro forma. And that means you need to understand what rents are on your market, income, expenses, what the cost is to rehab these units, and you need to, what we say, buy right, on these deals.
So I read Wheelbarrow Profits. You guys have, what is it called? Rubs?
Yes.
All these new terms, I highly recommend it if you want to get into this game, right?
Yes.
But what I found interesting was just these little nuances to make an extra buck was like rent the storage unit out.
Mm-hmm.
Right?
Mm-hmm.
Like, usually you think, all right, I get a condo and you just give them the unit. You give them the storage. Now forget them, rent that out for like $250 a month, or also get a coin laundry machine.
Yep.
Right. I like those little ideas that came out of that book. I still don't know what Rubs is though.
Ratio utility billing. So what happens is when you own an apartment, you're renting an apartment, the landlord can have one individual meter for the entire property. That means he pays for all the water. Or on the newer builds, each unit normally has their own separately water meter. In most markets, the landlord separates out and makes each individual renter pay their pro rata share. But a lot of these mom and pops, they don't do that. So they're leaving money on the table. So if you have 10 units and the water bill is, let's say, $1,000 a month, that would mean each resident would be responsible for $100 of the water of that bill. But mom and pops, they don't even do it. They pay it themselves. So when you see that opportunity, you're able to bill back to the residents their share of the water. You can see how much value you're adding onto a property. It's a significant amount of money. And that's the great thing about multifamily. You have so many different ways to generate revenue. You have pet fees, you have late fees, you have application fees. I mean, the fee game is huge. We do something called a non-refundable move-in fee. I don't want to get into that right now, but instead of taking security deposits, we charge a resident a fee to move in. It's non-refundable. Then we have something called a surety bond, sure deposit, so that we actually protect ourselves on the back end if they don't end up paying. But there's so many different ways to generate revenue with it. We have cable contracts as well. We're going out there and we're instituting contracts on our property to be able to say, hey, Verizon, Comcast, you have the exclusivity on this property, and they'll pay you a check up front. So there's so many different ways to generate revenue.
What are they going to pay for that?
On our last property where we had 156 units, we got a check for $30,000. I mean, $30,000 is a lot of pizzas, my friend. That's the way I look at it from now on. I look at it from that perspective. It doesn't seem like a lot, but $30,000 is a significant amount of money. Exactly.
How many pizzas are you making right now?
I'm making 0 pizzas right now. That's the great thing.
Yeah, but in terms of like from your rental properties, if you're going to put in the pizzas, how many pizzas are you making?
Making a significant amount of pizzas, a lot of pizzas. I never thought of that perspective. A lot.
I thought that was fun. I mean, what was COVID like? Did you have like challenges there? Obviously you survived it, but I mean, was it like stressful at all?
Well, if you take a trip down memory lane in March of 2020, the world was freaking out. Are people going to be collecting rents? Are people going to have a job? Is the world going to end? And Jake and I, remember the decision, the quality of your mind. We sat back and said, we have enough capital reserves in our accounts to float for the next couple of months. How is this new paradigm going to happen? We ended up doing virtual leasing because a lot of people couldn't go see units. So we implemented virtual leasing. We started tracking collections daily. So instead of tracking them monthly, we were tracking collections daily. And we're doing something called our physical occupancy versus our economic occupancy. Even though a unit's physically occupied, are they paying? So it's really important to track the people who are paying, and we were very strict about it. We were able to implement a lot of the money that was coming from all the different counties, municipalities that were helping residents pay. So we weathered the storm really well. Our rents have gone up significantly. You guys see with inflation, rents have gone up dramatically. And as far as the Jake and Gino and the education, in July of 2020, we did our first live event. So we waited 3 months. And for us, we've been able to prosper. I mean, we didn't understand that assets were going to explode as quickly as they did, as much as they did. We probably would have bought more because you're always looking at it. You don't know where the economy is going. You don't know what's going to happen with COVID. So for us, we weren't huge buyers in 2020. 2021, we only bought 150 units. We're probably going to eclipse that in the first quarter of 2022 here. So it was just a wait and see, just hoping that the economy stabilized itself and that residents were able to pay rents.
So how much are these 1,500 units worth now?
Probably $150 million, the portfolio.
How much debt are you carrying on those?
65% LTV.
And COVID just shot it up, right?
Well, the problem is COVID precipitated a lot of stuff. When there's a lot of money out there, and when money goes to banks, what do banks do? Banks lend to people who buy assets. So when you start lending money to people who buy assets, what happens? Asset prices start to increase. When you have low interest rates, it makes assets even more favorable. And then when you throw on this inflation, what ends up happening? Rents start rising like crazy, which means net operating income rises, which means valuations rise. So it's been such a domino effect. I don't know if they could have predicted it. I'm sure they could have, but in their infinite incompetence, they didn't think about it. They should have thought about it. Now you have all this money out there, and it's still chasing assets. So don't think out there that assets are going to take a pause because that money has to go somewhere. Is it going to go to the stock market? I don't think so. Is it going to go to oil? Well, we've seen it's gone to oil and commodities right now. It's gone to gold. It's gone to silver. Is it going to go to crypto? I guess it may go a little bit, but it's going to have to find a safe haven. And when you pull out and you look from a macro level and you're looking all over the world, we're still one of the safest places to invest capital. And multifamily and real estate in itself is a hard asset. And it is what people think a hedge against inflation. That's why when money flows, as an investor, you want your money to be flowing where everyone else's money is flowing. Supply and demand, simple supply and demand. And I don't think from that perspective and from real estate, it's a basic human need. It's food, clothing, and apartments. So people need it as a basic human need. There are more people renting. I mean, think about it. There's not enough single-family homes to go out there to buy. So those renters are stuck in their home and their renters renting because they can't go out and buy a home. So they're perpetual. Then you have baby boomers who are retiring, and you have millennials who are continuing to rent. Baby boomers are downsizing, they're renting as well. So that pool is getting even bigger. And, there's not enough supply out there. So it's just all those chain of events I see as far as long-term growth for the multifamily space and for real estate. It's going to pause, but I don't think it's going to tank like it did 10, 15 years ago.
So this was built since 2013?
It has all been built since 2013, yes.
I'm in the wrong industry.
Basically, your wealth has skyrocketed in less than 10 years.
And that's
probably doubled in the last 5.
That's why I like to say to everybody, when I hear politicians say that inflation hurts the wealthy, I want to vomit in my mouth, because it's the most hypocritical, disingenuous thing you could possibly say, because inflation helps people who own assets. Think about it. Your family, maybe you guys aren't old enough, but my parents bought houses back in the 70s and 80s. They got wealthy through inflation just from buying their home back in 1972, which was worth $24,000. They sell it in 2020 for $800,000 or $1 million. They got wealthy simply by their asset inflating. Now, if you're in the middle class and you're making $40,000 or $50,000 a year and you get a 6% rent bump in your wages, so what? You have no hard assets. Your cost of living has just increased. Gas has gone up by 80%. Cost of living, your rent in Knoxville for the last year has gone up 20%. So you've gotten a significant paycheck, but it's all going to the cost of living. But if you own your home or you own some assets, those assets are going to inflate, and that's what's been happening. So for those out there that think that inflation hurts the wealthy and helps the middle class, it's the opposite that what's going on. So for those of you out there, if you don't want to go broke, start investing, number one, in your education. Start investing, number two, in the rules of money. And number three, start investing in assets that will ultimately pay you.
Well, in your education, so let's hop on that. So Jake and Gino, you've got a pretty big following you've grown over the years, right? So
yep.
How big is that? Do you even know? You got conferences, or you got some annual thing going on?
So our students to date have closed over 35,000 units, asset values in excess of $2 billion. It's taken years, like anything else. It's long-termism. We've been doing this since 2016. Our first book came out back in the beginning of 2016. So it's been a great journey. And, the students, as they start onboarding, it takes 6, 9, 12 months to buy a deal, and then that deal to go out to refi. So for us, it's been awesome. We have internal boot camps with our students. We have our multifamily conference every year. Last year, MM4 was in Orlando in October. We had 900 attendees. This year, it's November 5th and 6th in Orlando. We're probably shooting for 1,200 attendees. It's really, when you want to be successful in life, it's not just the education. To me, what I found is it's the accountability. I have a partner named Jake. He's my accountability partner. I have these podcasts, which are really accountability things in my life. And that's why I created the Jake and Gino community. It's not just about the coaching. It's not just about the education. It really comes down to the networking, surrounding yourself with like-minded individuals and being held accountable to doing the work and showing up and making sure that the work is done.
So you could retire. You got enough assets. You got enough cash flow, I'm sure. What's the goal here?
The goal for me, everyone defines retirement as something different. When I retired from the restaurant. That was my goal of retiring. I think what everyone needs to do is to create their own core values. My core value, I took it from Sharon Lechter. We had a podcast with her a couple months ago, and it really resonated with me. She said that her value in life is to add value every single day to somebody else. And if that's my core value, I don't want to retire because I want to be on these podcasts. I want to write books. I want to help students close deals. I want to partner with students doing deals. I want to add value every single day in any way that I can. And I can't do that by sitting on the beach or hiking or doing any of that stuff. So for me, crystal clear, retirement is a different picture than most others. I retired at the age of 46. I left that former profession and went to this full time. I love what I'm doing. Retirement to me is working with who I want to, when I want to, where I want to, and most importantly, why am I doing this? Why am I chasing this opportunity? Does it align with my values? And that's what retirement is. It's all about autonomy. That's what money gives you. It gives you the autonomy. It gives you the decision making. If I don't want to be on the show, I don't have to be. I want to be. And when you can live a life like that, who the hell wants to retire? You're playing with house money. That's the reality. That's what people don't understand. Money gives you freedom. That's what it gives you. It gives you the choice, the ability to choose to what you want to do. Okay? The only difference that I have with 5 years ago and now, I don't mind if I have to fly first class. I don't mind spending a couple $1,000 for a ticket. Whereas a couple years ago, I couldn't do that. Now I have that option. It just gives me some more options in life. But it ultimately gives me the freedom and the autonomy to choose what I want to do throughout the day.
Do you think you're taking more risk now or less?
I'm taking, if you define risk, taking risk for me, in multifamily, that's why we slowed down buying, because we thought we were at a top. So for me, it's continuing to set guardrails for myself, being able to say, I want to buy these assets. This is what I'm looking for, and sticking to the framework that we've created. Once we go out of that framework, and we start what we call pencil whipping deals, where we start making up numbers, or we start making up false projections, that's when risk comes into play. But that's why you have a partner to check you and say, hey, I don't think that deal looks so good. Let's go back and review the deal. So for me, risk, I think people who are uneducated, or like you said with the stock market before, if I'm going to go into the stock market, I'm going to start leveraging my portfolio and taking a loan against that. That to me is risk, because I don't know that venture. But for me, multifamily long term, I need to buy an asset for the next 10 to 15 years. If I have that mindset, I will be okay. But if I'm looking to buy an asset in the next 2 to 3 years and try to flip out of that, there's where the risk comes into play.
What are your thoughts on putting solar on these properties? For
me, it's solar. I just don't understand how solar is going to work. I don't know. I mean, like with these electric cars and all that, I don't see that as the future, because California doesn't have enough electricity to meet the demand without putting every single car on electric. And then what happens in the long run once these panels are done? Is it environmentally conscious to throw them into landfills? I don't see that going. And now it depends what every state does. If you're getting all these rebates and you're able to get money back from it, hey, that's great. But you know what happens with technology? They're on a roof. They're going to get damaged. They need to be maintained. I mean, to me, I think wind is one of the biggest jokes. You have all these wind farms going on. You know how intensive it is to keep wind farms going? People don't think of it. I think solar, as the technology improves, I think as it is now, it's not good. But once technology improves, once the ability to collect it and to be able to distribute it improves, there will be. But for right now, we're not putting anything on our.
Wouldn't you just want it for the tax credits? Because you get a massive tax credit.
It depends what
you already got enough tax credits.
Yeah, it depends what state you're in. Remember, I think New York has got better tax credits, and other I would say blue states have it, but I don't see the tax credits or the tax benefits as much in Tennessee. And that's another thing you need to maintain. Remember, it's something else that's there that you have to maintain as well. So it really depends. Cost-benefit analysis, and ultimately, what's your return on investment? How long is it going to take for you to spend $300,000 to put solar on your property? Is it going to take you 5 years to get your money back, or is it going to take you 12 years to get your money back? That depends upon what the projections are, what the savings are, and then the problem that I have with solar, and you guys should understand this, when the government makes up a rule, they can change it anytime they want. All of a sudden, you've got it on that you're generating your own electricity. Oh, we're not buying back the electricity excess. Well, there goes the plan right there. And they can change the rules anytime. So when you get in bed with the government, whether it's a 529 plan, a 401k, any of those plans, just make sure, read the fine print, and they can change the rules anytime.
All right, I'll hop to a card because we usually do at least one.
Then we're going to wrap things up. We're going to go into the box of questions. And while Andrew's finding a question, Gino, where do you want people to find and reach out to you? You gave your email earlier. Where's the best place?
Just go to jakegino.com. All the information is there. The website's there. The 4 or 5 weekly podcasts we do are there. And like I said, if you want to email me, it's gino@jakegino.com, and I'll send you a PDF copy of Creative Cash.
And it's Gino, yep. Gino.
Yep, Gino at Jake, ANDGINO.com.
G-I-N-O. Let's go.
I don't know which one you're going to pick here. I pulled this. I don't know what you're going to pick. Which is more important, intelligence or common sense?
I know a lot of intelligent people that don't take action. I want common sense personally.
What is common sense? What is common sense? What does that really mean?
Well, go ahead, shoot.
Well, I have an answer.
No, go ahead.
Gino has an
Love to
answer
hear
right
yours.
now. Common sense is like you go to Thanksgiving dinner with your family. Like they invite you over for dinner. They have a big, beautiful spread. And you eat the turkey. Turkey's a little dry. And someone asks, how's your turkey? You spent no money. You had a free meal. And you go, turkey was dry. And you're just like being a douche. Like you just got a free meal. Like if you want your own turkey, it's not going to be dry. Like make it your own damn self. That's like
yes, and the intelligent person would go,
sense.
"Wow, I would have cooked at 165 internal degree temperature. I would have done 3 hours. I wouldn't have put the stuffing in there. I would have put a little bit of glaze in there." He's intelligent. He knows how to do it. But like he said, you're a douche. I don't want your opinion. I just want you to,
So little white lie. Is that what it is?
Sweet.
A white lies are common.
Well, I wouldn't say call it a white lie. You're not telling him. You're telling him. It could. That's a tough one. My son goes down that slippery slope when he discusses.
What does he do?
As far as not telling a lie, it's a difficult thing. It's a moral dilemma that I have because when you're in business, it's very difficult. For instance, I tell him, Mike, can you call up this apartment complex? I want to know what the rents are. Do a secret shopper. Tell him you're going to move in with your girlfriend. He goes, Dad, I'm not moving in with my girlfriend. I'm lying. I'll just call them up and tell them that I want to know what the rents are. I don't have to tell them why I'm calling or what the excuse is. I'm like, okay, do that, Mike. So it's very, very difficult. This constant challenge that we have in business throughout the day. And he's like, Dan, kid's 19 years old. He's got a much better moral compass than I do. I'm like,
his morals are too high.
Exactly. Where did he come from? But you know what, though? That's his integrity. I'm blessed to have a son like that thinks like that. And if you want to live life like that, it's challenging every day, but there's a moral code to that, and I have a tremendous amount of respect for that. I'm trying to be a better person.
Aging hardens us, right? It makes us just more colder and icier sometimes, and just get it done. And that's what kids are for. They remind you.
Yep.
No, I did say that. I did say that. Yeah, I said I'd do that, but I thought I could get away. I'm sure you got 5. I thought I could get away without doing that. And he's holding my feet to the fire 10 minutes later.
Exactly. Love that.
Well, sweet. Anything else, Andrew?
No, man.
Gino
it's
run?
awesome. If with Jake and Gino, check them out on Instagram. That's your following. If I know a lot of people are interested in getting into multi, and they're going to start following you, and they're going to love this. And yeah, I mean, like I said, this is a master class. You know what you're doing, and I'd get those books too. And like you mentioned, take action. That's the scary part, because just I like what goes through my head. I'm like, I don't want to be a landlord. I don't want to, like, what if the market goes down, or I'm not living there, right? That scares me. I'm not the one living there. So I don't know who's living there. And then squatters are a thing, or I'm sure you maybe have run into that. So like all the negatives run through my brain, and then I'm like, it's too hard. I'm like, forget it. But then I hear, my favorite book, I grew up reading this when I was a little kid, Robert Ringer, Winning Through Intimidation. Have you read that one?
No, I never have. No.
Check it out. It's unbelievable. And I grew up reading that. So I always thought I was going to be in the multi-broker game or multi-investment game. It's my favorite book growing up. And for some reason, I just kept having those fears. I was like, it's too hard. I just don't want that responsibility, that scare. So I just never got into it. So it's definitely a little scary. But I mean, I did have one rental for a minute because we moved out and we had cash flow. I mean, it's making money doing nothing.
Yes.
So it's like, wow, we had cash flow, it paid for the cars. And I was like, this is great. And they ended up failing on paying me. I kept the deposit. I kept the first month, and I ended up re-renting it quick. It just all made sense, but it was the only reason I got forced into that situation because I couldn't sell it. So, and that was in at 13, but it's interesting to see certain businesses, you can go higher in some of them than others over the last 10 years. And you've done great. I mean, that's remarkable.
Thank you.
So, Yeah, man. All right.